Welcome you all to the first session on business finance and course unit BMGT 3065. So today we will discuss the first section, which is the first topic, which is the introduction to finance. I'm Uttara Disanayaka. So we will be discussing these topics under today's session, and you will, after completing this session, you will be able to achieve these learning outcomes. The first one is to examine the balance sheet statement of changes in the financial position of a business. Secondly, discuss the sources and uses of finance, and then comprehend the financial decisions and analysis of business functions, demarcate the finance function from the accounting function, discuss finance as a function and corporate strategy, and associate corporate objectives and finance objectives. And finally, we will discuss and you will be able to distinguish the shareholder wealth maximization and corporate value creation. So with that, we will move on to the next slide. That is the statement of financial position or the balance sheet. So as you all know, I hope you have a clear understanding about what a financial position is, or what a company's balance sheet is. So we normally say that a company's balance sheet is a snapshot of the firm. So by looking at the company's balance sheet, you will be able to identify the position of the business, or the assets of the business, or what type of assets they have, what types of liabilities they have, and what is the ownership of what is the what is the percentage of ownership for the owners of that particular company or the business. So all these things will be able to you will be able to get an understanding of all these things by looking at the balance sheet. So that's why we say it is a snapshot of the firm. And if I read on the second point, it says it is a convenient meaning of an organizing, summarizing of what firm owns. That means the firm's the things that the firm owns. That means the firm's assets. If something, if we say that the firm owns something, and that ownership is represented by assets, right? So let's say the company is having these the company is having or the company owns these types of instruments, let's say these types of buildings and these types of vehicles and these types of lands. So all these things comes under assets. And what firm owes, that means for what the things that the business firm is liable, right? The things that the business firm has to pay back to some other third party, or some other creditor, or a person who has given money to that particular company. So those are known as liabilities. And the difference between those two in the sense, the assets and the liabilities, right? So in one side we have the assets, or the things that the company owns, and in the other side we have liabilities, that is the things that the company owes, or the things that the company is liable. And the difference between those two, so those two things are known as the firm's equity, or the owner's capital. So we will be able to identify all these three types of things by looking at a balance sheet. So that is why we say that we can have a snapshot of the firm by evaluating a balance sheet. And it indicates the financial condition or the state of affairs of a business at a particular moment of time. So then we have we have the things, and we will be able to identify the financial position, or the state of the business, or state of the business, or the state of the company at a given point in time, or a given moment of time. So that means as at so let's say if I take the normal date, so as at 31st of December, what is the company's position or what is the company's assets? So what are the company's liabilities and what are the uh, how much is the company's equity? So we can have a clear understanding about those types of affairs and those types of ownership and the financial condition at a particular moment of time by using a balance sheet. Right. And so we will move on to the definitions of assets and liabilities, equity. So I know you have a clear understanding, but for the sake of introducing all these things to you all, we will go through this one by one. Firstly, we will look at the definitions of assets. Asset is the present economic resource controlled by the entity as a result of past event. An economic resource is the right that has a potential to produce economic benefits. So if you have an asset, that should have these types of characteristics. It should have it should be a present economic resource. So you will be able to generate some economic benefits or economic gain from that particular asset, and that a particular asset should be result from a past event. So those types of things, if those types of things is there, so we tell them as assets. So if I take an example, so let's say you're talking about lands. So a land is there and you're a land is there, that land is given by you are giving or the mortgage in that land to for a car sale. Then that land is bought, you bought that land in a at a previous date. So you bought that land previously by paying some amount of money. However, you're using that particular land as a car sale and you're getting the you're renting that land for a car sale and you're getting a particular rental income. So that is your economic benefit. So that therefore that land is known as an asset. That is because that is present, that has a present economic resource that is controlled by the entity and as a result of past event. And we can classify the assets as either current or fixed. So if we say as fixed asset, so that asset should have a economic life or the lifespan longer than 1 year. And if we say it has a current asset, it should have a lifespan less than 12 months time or 1 year. And fixed asset is one that has a relatively long life, that is relatively long in the sense more than 1 year. And fixed asset can be either tangible or intangible. So we can have both tangible and intangible fixed assets. If a fixed asset is tangible, so we can touch that, we can feel that, right? So if you have some buildings and if you have some vehicles, if you have some land, so you can touch and feel that. If you have machineries, you can touch and feel that. So that is tangible. If you have like a brand name, a goodwill, so those are all so known as fixed assets or tangible assets, intangible assets. So however, those goodwill and those patent rights, so those things cannot be touched, right? So you can't touch those things. So those are known as intangible assets. And the current assets has a lifespan less than 1 year. So these things also explains about those assets or types of assets. Fixed or if we talk about fixed asset, it has a fixed or long-term assets that are held for periods longer than the accounting period, right? So what is an accounting period? Accounting period is a period, generally we say an accounting year or accounting period is 12 months time, right? So if it is an accounting period or accounting time period, it's has a lifespan or it has a span of 12 months or 1 year, right? If you have a fixed asset, that period is longer than 1 year or accounting period, and they are held for use in the business and not for the purpose of sales, right? So we have like if we have a fixed asset, so that asset should be held in the business, not for the purpose of the sale. So you can have economic benefits, however you cannot held those, or you cannot keep those assets for the sake of reselling them, right? So we normally in a like let's say in a in a garment factory, the vehicles that are used for distribution are known as fixed assets, or vehicles that are like used for transportation are known as fixed assets in a garment factory, right? So you can say like you can understand that in a garment factory their main purpose, or their main business is to manufacture garments or manufacture clothing items. So therefore the uh, assets or the vehicles that they are using is for a transportation purpose, or to like for distribution purpose. So those types of garments that are having those um, vehicles, and those vehicles are categorized as fixed assets. So that is one case. However, let's say you have uh, mm, a car sale, or you have a vehicle sale, right? So so let's say Indra Motors or Ishara Traders, right? So those types of businesses, the vehicles are not identified as fixed assets. Though in those types of businesses, or in those types of businesses that are having vehicles in their business, while having like a business called as car sailing or vehicle sailing, vehicle reselling, then the vehicles are categorized as goods, right? Goods for sale, right? Then that won't be categorized as fixed assets. So what I'm trying to explain you is that, so if if an asset has a larger time span or larger economic life, more than 1 year, and that is held for more than one accounting period, and that asset should cannot be used for the purpose of sales, then only it is becoming a fixed asset, right? And the tangible fixed assets, that means the fixed asset that can be, that one can touch and that one can feel, right, are known as building machinery, vehicles, lands, likewise, right? So those tangible in this, or every time tangible in the sense you can touch, and on the other hand intangible in the sense you cannot touch or feel, right? However, some fixed asset is there, but you cannot touch or you cannot feel that. So then we call them as intangible fixed assets. So those are patent, trademarks, goodwill, and so those things, right? So a patent, if we talk about a patent, so you can't touch a patent. So that is the ownership that you have for a for an innovation you have done, right? So then you can touch that patent, or you cannot touch that patent, you cannot feel that patent, right? So that is why we say it as a intangible fixed asset. And on the other hand, trademark, so you cannot touch the trademark that you're having, and you cannot touch your brand name, right? Brand or the brand name you cannot touch. So so those things are known as intangible fixed asset. However, if you have built a brand name, or if you have created a patent, so that is that is with you for a longer period of time, for like 100 odd years. However, you cannot touch that, or you cannot feel that, right? So that is why we say those are categorized as intangible fixed asset. However, the things that you can touch, you can feel, you can feel the presence. So those are known as tangible fixed asset. So a fixed asset is always a asset that has a present economic resource that is controlled by the entity as a result of past event. It should be generated as a result of a past event, and that should be controlled. That should be present, and there should be a economic resource that should generate economic benefits to the owners and for the people who are using that. So if so, that is identified as an asset, and the assets can generally be classified into two types. The first one is the current asset. The second one is a fixed asset. If you categorized some assets as fixed asset, that should have a long lifespan. Generally, we say that is more than one accounting period. One accounting period is for 12 months or 1 year. So if you have a fixed asset, that should always have a economic lifespan more than 1 year. Right, and those fixed assets can be categorized as tangible fixed assets and intangible fixed assets. So tangible fixed assets you can touch, feel, and you know that the presence is there. You can feel that, you can see that, right? So uh, if so, it is a tangible fixed asset. So if you cannot touch, or if you cannot feel that, if you don't see that in your naked eyes, so then we can say it as intangible fixed assets. And the next category is the current assets, right? So what do you mean by current assets? A current asset is sometimes called as liquid assets. So what do you mean by liquid? Liquid in the sense we can convert those assets into cash very easily. So if you can convert that into cash very easily without incurring any loss, so then you call that particular assets as liquid assets. So you have a particular asset, and if you need some money, you can straight away go and convert those assets into cash, right? So then the loss that you are generating is really low, or you don't ever incur a loss. So then those assets are known as liquid assets. Then normally the current assets are having an economic lifespan less than 1 year, right? So those assets are expected to be converted into cash within the accounting period or operating life cycle of the business. So you will learn about the operating cycle under working capital of the business. And the current assets include cash, account receivables, inventories, likewise, right? So if you have inventories, or if you have goods for sale, so if you want some money, like if you hurriedly need some money, so you can go to that, you can sell the goods that you're having and you can take the money. So then those even in a even in one even in 1 hour or 30 minutes, you can sell that particular assets and convert that inventory into cash, and you're not generating a huge loss by converting those into cash. Then we called that as current assets. And if you have account receivables and you need money, then what you can do is you can go to a bank and you can factor, or you can give those account receivables to a particular financial institution or bank, and you can take some amount of money, and you can, or else you can ask your account receivables or the debtors that took money or took goods from you on credit on to give you back those money, right? Then you can have money very easily. That is why we say the assets are known as liquid assets, and those current assets or the liquid assets have a lifespan less than 1 year, right? So the next one is liabilities and owner's equity. All right. So what is the so we will firstly go through the definition of liabilities. that at present, a present obligation of an entity to transfer an economic resource as a result of past event. So that is the opposite of the assets. So in assets, it's generating generating economic benefits. So it's an present accounting resource that is controlled by the entity, which is generated as a result of past event. On the other hand, so if we talk about liabilities, that is also resulted by a past event, and that also has a present obligation to transfer the economic resources. Right? So you have a present obligation to transfer the economic resource. An obligation is a duty of responsibility that the entity has no practical ability to avoid. Right? So that is why we say it as a liability. So that liability has been generated by your past events. So sometimes you might have taken some loans from a bank. Sometimes you have bought some goods on credit, right? So then you have bought the goods on credit and you have taken a loan. That is a past event, and now you have the obligation to transfer economic resources in the sense money, mostly money, monetary benefits, so monetary resources. So you, because you have taken a loan in the past, you have an obligation to pay back the loan to the bank. Then you are passing, then you have an obligation to pass the loan to the pass the money to the bank, right? So that is why we call that as um, a liability that is happening, though that is incurred by that is resulted by a past event. However, that is the economic benefits are transferred, right? And the definition of owner's equity. So while explaining the liabilities, I have given you some examples. So we can say liabilities as loans and advances that we have taken, or else the trade payables or the goods that we have taken on credit. And on the other hand, we can say the if the company has taken overdrafts from banks, those things can also be classified as liability, and the leasing facilities that has been taken from financial institutions to purchase vehicles and all. So all these things are known as liabilities, right? And the next one is the owner's equity, the residual interest in the assets of entity after deducting all its liabilities, right? So if you want to calculate the owner's equity, what you can do is you can deduct the total liabilities. I forgot to tell you, the liabilities can also be classified into two types, known as uh, current liabilities and the long-term liabilities, right? So the long-term liabilities are having an obligation or having obligation to pay for a period higher than 1 year, and if it is a current liability, that is having an obligation less than 1 year, right? So you can have both liabilities, or you can have only one in your company. So if you want to calculate the owner's equity, what you have to do is you have to deduct the current liabilities along with the long-term liabilities. So if I say the total liabilities by the total assets. Total assets also include what? The current assets and the fixed assets. So the current assets and the fixed asset includes the total assets. Current liabilities and the long-term liabilities include the total liabilities. By deducting the total liabilities by the total assets, we get the owner's equity. Right. Then the liabilities can be, as I told you previously, can be categorized into two types. The first one is the current or the long-term liabilities, and the second one is the current or the long-term liabilities. The second point, current liabilities have a life of less than 1 year, and a debt that is not due in coming year is classified as a long-term liability. Yeah, so if you have taken some loans in this year, and if you don't need to pay or settle that particular loan in this year, um, then that will be classified as a long-term liability. So normally we say long-term liabilities as bonds or debentures, right? And if you have current liabilities, so you have to pay that within 1 year. And finally, by definition, the difference between the total value of assets and the total value of liabilities is the shareholders' equity, also called common equity or owner's equity. And the next one is the net working capital. The net working capital is the difference between a firm's current assets and its current liabilities, is known as the net working capital. So if you want to find the total owner's equity, so you have to deduct the total liabilities by the total from the total assets. However, if you want to find out the net working capital, normally the working capital is associated with the short-term liabilities and the short-term assets. So if you want to find the net working capital, what you have to do is you have to deduct the current liabilities by the current assets. Net working capital is usually positive in a healthy firm. So why we say it is usually positive in a healthy firm? Because if, like, let's say if that particular asset is, let's say, net working capital, right, is equal to current assets divided by current liabilities, right? So if I give you an example, so let's say the current assets are 100 and the current liability is 50, then the net working capital is how much? It is plus 50, or we say normally it's 50, right? Then this type of a firm is known as a healthy firm. Why is that? That is because the current assets are higher than the current liabilities. Then by paying all the current liabilities, this firm has some current assets left with them. So then that is good. And if in the other case, net working capital is the current assets divided by current liabilities, then the current assets is 100, the same scenario, and the current liability is 130. So now what has happened? The current liability is higher than the current assets. Then what will happen? This will become minus, right? So then what we can say, or what is indicated by this? So you don't have enough assets, or you don't have enough resources to pay back your short-term liabilities even. So then that is not a healthy firm. That is why we say if the firm is healthy, the net working capital should be positive, right? So that is what is explained here. Right, and build in the balance sheet. Create a balance sheet and discuss the resources and the uses of funds. Right? So it says create a balance sheet and discuss the sources and uses of funds. I hope that you know what a balance sheet is. So what we can see is in the balance sheet. So this is a normal balance sheet. So if you want to draw a balance sheet, normally we are like for the simpler form, we are drawing it as a T account, right? That is balance sheet, right? It's normally a T account. And here we have assets. Uh, we have fixed assets. And then we have the current assets. In a balance sheet, every time in a balance sheet, in the right hand side, we have assets, right? In the left hand side, we have shareholders' funds, that is equity. Equity. And then we have long term debt. Then we have short term debt, right? So if, like, let's say, as I told you previously, if you want to get this, we have to deduct the assets by the liabilities. Then we get the capital or the owner's equity, right? So that is how it happens. So that is a normal balance sheet. So here I have given you the balance sheet model of a firm. So here also you can see, or you can identify that these this is the fixed asset, or the left right hand side we have the assets. And firstly, on the top, we are putting the fixed assets. So the fixed asset can be categorized into two types. The first one is the tangible, and the second one is the intangible. So under the tangible assets, you can have land, building, motor vehicles, machineries, and all the things. And in the intangible asset side, you can have the goodwill, the patent, the trademark, the brand name, and all these things. And on the bottom, you can have the current assets. So those are the liquid assets, or the assets that can be converted into cash very easily. Then you have the inventory, the account receivables, and the cash. And on the left hand side, what you have is you have the shareholders funds, or the shareholders funds includes the share capital and the reserves. So what do you mean by reserves? Reserves are the things that so in a firm we generate profits, right? So by doing the business, we generate some profits. So the profits can be either be distributed to the owners or the shareholders, either be kept by the company in order to do what? In order to grow their business in the future. So you have some profits with you. So you have two things. You can do two things. Either you can distribute those profits to your shareholders as dividends. Either you can, or else you can keep those profits in the firm as reserves in order to use it for future expansion purposes likewise, right? So we call those the funds that are kept in the business, or the profits that are kept in the business, as reserves. So the shareholders funds includes two types, that is the share capital plus the reserves. And also you have on the left hand side in the middle, you have the long term debt, or the debt that are or the debt that are having a lifespan or an obligation that is higher than 1 year. Those are known as a long term debt. And also we have the short term debt that is payable within 1 year, right? So the short term debt are the account payables, accruals, and short term loans. Right. So on the by looking at the right hand side, or by adding the right hand side, was what you can get. You can get the total value of the assets. Right. So by adding the fixed asset and the current assets, you can get the total value of the assets. And on the left hand side, by adding the shareholders funds, the long term debt and the short term debt, you can have the total value of the firm to the investors. So if a firm is getting some loans, or if the firm is getting some like money from selling financial like selling debentures, corporate bonds likewise. So those are those are the ways how these investors invest in that particular company. Or else if that company is having shareholders funds, then that is how the investors invest in that company. So by adding these left hand side, what you can get is you can get the total value of the firm to the investors. The addition of the right hand side is the total value of the assets. The addition of the left hand side is the total value of the firm to the investors. Right? Then, by looking at that, we can, I hope you get a clear understanding about the assets and the liabilities and the owner's equity, and how does the balance sheet impacts the business, and how the balance sheet is like how you can read a balance sheet to get an information, how these assets, liabilities, and owner's equity can be categorized likewise. And on the next slide, so what we can do is you can see the um, financial management decisions. From the created balance sheet, discuss the decisions related to with finance. Right. So by using the balance sheet, so you can take several decisions. Right. So the first one is the investment decision. So what do you mean by an investment decision? So if you're like if you have a business, and if that business wants to get growth, and you want to expand your business, so you need to invest in fixed assets, right? You need to invest in machineries, you need to invest in several lands, buildings, and many projects that are generating profits. So that those types of decisions, or you need to take some decisions based on that. So what types of assets that we are purchasing, what types of decisions that needs to be taken, and whether we are purchasing this asset or that asset, or so in a business we can't take each and every each and every machinery we want. So what we have to do is we have to get some decisions, right? So we don't have money, we don't have a large amount of money, the money is limited, right? Money is limited, and the things that we need to purchase are higher than that. So then by having the limited resources, what we have to do, we have to identify and we have to analyze the things that the long-term assets or the long-term projects that we are um, purchasing, right? So we have to analyze all those things, or all those assets based on the lifespan, based on the benefits that they are generating. And we have to make some decisions based on their returns and all that. So those types of decisions are known as investment decisions, right? So that is the first decision, that is how we are raising money. Oh, how I mean, how we are on what projects that we are investing, or in what is the best project that we have to choose. So those types of decisions are known as investment decisions. And on the other hand, we can take financing decisions. Financing decisions in the sense, so if we like in a business, we need money, right? So money can be generated in two types. So we can have in a so in finance, we are always talking about the large scale companies, or the public companies that issue shares to the public, right? So if we are talking about those companies, so the companies can raise money in two types, right? So they can issue shares, or they can generate shares, or they can issue shares to the shareholders, then the equity capital will be raised, right? So if we like issue shares to the shareholders, and if shareholders purchase our shares, then equity or the owner's capital will be raised. And on the other hand, we can, if we need money, we can instead of like issuing shares, what we can do is we can take a loan, or we can take a we can issue a financial instrument, or we can issue a corporate bond, right? So then what we are taking a loan from the investors, or we are taking a loan from a bank. So that is another way. Then we are raising the debt capital. If we are issuing shares, we are raising equity capital, that is owner's capital. And if we are raising debt, and if we are issuing like financial instruments, or we are taking a loan to take our money, take the money that we are requiring, that we need, then those types of assets are, or those types of mm, funds that we are raising are known as the debt capital, right? Then as a firm, that firm cannot like straight away go to particular shareholders and like just straight away decide that we are like issuing shares. No, we are issuing loans, so though we are taking a loan, so those things cannot be decided by just like in a straight away or in a nutshell, right? So what we have to do is we have to analyze. So we have to see the cost that we are incurring, so what type of risk that we are facing when we are taking those types of decisions. So we have to evaluate and see. Then how we are raising the money that we need is another types of decision that a finance manager or a financial management professional has to take. So that is known as the financing decision. Firstly, we have to decide, or we have to decide what types of long-term assets that we are investing in, how we are taking money, or how we are using the money to purchase goods and or fixed assets. So what types of projects that we are investing is another decision that is known as investment decision. So that is where we are making an investment. On the other hand, we have to see, or we have to take a decision, or we have to decide how we are raising the money. So that is known as financing decision. And on the other hand, the liquidity and working capital decision. So in working capitals, we cannot take like um, working capital in the sense the day-to-day money that we are using, right? Day-to-day capital, or the current assets and the current liabilities. So how we are using the current assets and the current liabilities, and how we are using those inventory, account receivables, account payables, are decided by using the working capital decisions. How much of money is like can be categorized as working capital, and how we are using those are known as the working capital decision. And the dividend decisions, right? So as I previously told you, we have if when we are generating profits in a company, we can have two decisions, or two like we can have like we can decide base we can decide how we are like what we are going to do to that profit in two ways, right? So the first one is we can keep that profits with us without distributing to the shareholders or the owners, in order to make some expansion purposes, and in order to increase the business. Or else what we can do is we can distribute the money, or distribute the profits that we are getting to the uh, shareholders. If we decide to distribute the profits to the shareholders, we have to see how we are going to distribute, in what percentage, what is the amount that we should give to the shareholders likewise. Then those are known as the dividend decisions. So basically in financial management, we have four decisions. However, in most cases, we are not taking this liquidity and working capital decision as a main decision in finance. So therefore, we are like mostly we are talking about the investment decision, financing decision, and dividend decision as the three decisions. However, we can use the working capital or the liquidity decision as the fourth decision, right? So those are the financial management decisions. So the what are the types of investment decisions that we are taking cannot be can be discussed by using the fixed assets or the fixed asset portion, right? Right. This is the investment decision. Right. And how we are going to raise the money can be decided by using this. If we raise shares or if we raise shares, so that is known as share capital. And if we take money from loans, so we can categorize that as debt capital, equity capital and debt capital. That is, so when we are deciding that how we are going to raise money is known as financing decisions. And how we are going to like um, manage the short term debt and equity, or short term uh, debt and equity, or debt and assets are called as working capital decisions. So that working capital decision can be identified by using the short term debt and current assets. That is working capital. And on the other hand, the dividend decisions. So you have the reserves, right? So you can, by having reserves, you can decide whether we are going to distribute as dividends or keep that as reserves, as retained earning. That is the dividend decision. Right. So those are, this is how we are going to like, um, this is how we are going to like identify these financial decisions by using the balance sheet. So I hope you understood up to this point, right? And then we are discussing about the sources of finance. Right. So, what do you mean by the sources of finance? A source or sources of finance refer to where a business gets money from to fund their business activities. Sources of finance. So, by the word itself, you can see how the business gets money to fund their business activities. Right. And A business can gain finance from their internal and external resources, and basically the sources of finance can be divided into debt and debt capital or equity capital. And so as I told you previously, uh, in the financing decisions, we are deciding whether how we are going to take money or how we are going to have money, that is from debt capital or equity capital. Further, financing source could be an internal or external, right? So you can have internal sources or external sources. It's internal sources in the sense. And so, as I told you previously, we have profits in the previous years, and we didn't pay those profits to the shareholder or distribute the profits to the shareholders as dividends. So we have a large amount of reserves. So if at the time we are requiring or at the time we need money, so we can use those resource or reserves as a source of finance, then that will be an internal source of finance. And if you don't have resources with us and we need money from external parties, so then we are raising capital, or we are taking a bank loan, or we are like issuing debentures. Then those are known as external sources of finance, right? Then source of finance is the way that we are getting money. So those types of financing can be known as debt capital or equity capital, and those can be external and internal as well, right? And capital, debt capital can be debt capital are the interest bearing borrowings. So if it is a debt capital, right, debt in the sense the liabilities that we are having. So if we are taking a bank, so normally bank loans and debentures are the main debt capital that a firm uses to get money by using the debt capital, right? So generally, even if we take a bank loan, they charge an interest. So for the firms, even if we take a loan, they charge interest, right? So though and if we like have debentures, and if we offer corporate bonds, corporate debentures, then they are charging an interest. Then those are all the types of debt capital is known as interest bearing borrowings. And on the other hand, we have equity capital, right? Equity capital, in the sense, if we want equity capital, we have to issue ordinary shares. So if we are issuing ordinary shares, then we are increasing the ownership of the company, right? Then we are creating new owners of the company. Then those are known as the ordinary shares. And you can use equity capital as a source of like retained earnings as an equity capital as well. So what do you mean by that? So as I previously told you repeatedly, so if you have previously generated profits that you didn't distribute to your shareholders, then those are known as retained earnings. If you need money at a particular point in time, you can use those retained earnings to fund your particular business, right? So that is the two extreme points, that is the debt capital and equity capital. On the other hand, you can have another capital that is known as the preference share capital. So what do you mean by preference share capital? So initially you're issuing a kind of a share that is known as a preference share. Then not like the equity capital, you have to pay a particular interest amount to that a fixed interest amount to that particular preference shareholders. In the ordinary shares, you don't need to pay any interest or any debenture, any dividends, right? So you are not entitled to pay those, right? You are not entitled and you are not liable to pay those to your equity or ordinary shareholders. What you have to do is, if your company earns profits, so by looking at those profits, what you can do is you can have like looking at the profits, and if the management thinks or the directors thinks that uh, some amount of profits can be distributed to the shareholders, then only they are getting the dividends, otherwise not. However, in this preference share capital case, they are entitled to have a particular interest, yearly or semi-annually, right? However, in this the thing the other feature that is that can distinguish the preference shares from equity capital is that they have uh, in preference shares they pay some amount of interest for the shareholders. However, in equity capital they don't. On the other hand, they have right, they can convert those preference shares to equity shares at the maturity. For the old equity capital, we don't have a maturity date, right? Equity for equity capital, we don't have a maturity date or a like expiry date. However, for preference shares, they have. On that particular date, they can convert that into owner's capital or equity capital, right? So on the next one is that the business functions. So up to now, what we have discussed, to now we have discussed about the statement of financial position or the balance sheet. We have discussed the balance sheet is a snapshot of a firm, and that shows and that summarizes the assets, liabilities, and owner's equity of a firm in a particular point in time, and that shows how is the bank's or financial condition of the firm and the financial position of the firm. And we can define the assets, all right, and we can define the assets, and we can identify the things, and we can like have a definition, and we can identify that the assets can be segregated into two types mainly, known as fixed assets and current assets. And on the other hand, those can be categorized as tangible and intangible. We have given like we have discussed the examples for those things as well. And the liability is the definition of the liability we discussed, and the the examples for liability. And we also discussed that the liability can be categorized into two types, known as current liability and long-term liability. And we defined the owner's equity. I have told you that the owner's equity is the difference between the total assets and the total liabilities. And we have discussed the difference between the what is the net working capital, that is the difference between the current assets and the current liabilities. And it also shows the healthness or the it is also it is always positive in a healthy firm. And I have discussed how this balance sheet is built, and how these financial management decisions can be impacted or can be showed in a balance sheet. And after that, we have discussed about the sources of finance, and how these and what are the main sources of finance, and what can be like um, what can be what types of sources of funding or sources of funds that can be raised to a firm. And those types of funds can be categorized as external and internal, and they can be divided into debt and equity capital. And I have given you some examples, and I have told you that the equity capital is always the owner's capital. Therefore, they don't the equity shareholders are not entitled to get dividends. However, this uh, on the other hand, this preference share capital is entitled, preference shareholders are entitled to have dividends, and dividend interest, and there's a maturity period for preference shareholders. Equity shareholders doesn't have that. and the preference shareholders can convert their shares into equity capital at the maturity date. And on the other hand, we discussed about the debt capital, and all the debt capital has a interest bearing borrowing. Debt capital are known as the interest bearing borrowings, and mainly in every firm we can see that the bank loan, debentures, leasings, overdrafts are known as the debt capital. All right. So that is the end of the first part. So next we will discuss about the business functions.